Hi everyone, Josh Horn CPA here, Horn Valuation and Tax. This video I did as a follow-up to the bucket video, which I hope you've seen by now. If you haven't, please go back and watch the bucket video. It's about goodwill and business valuation in the context, particularly of divorce and allocating goodwill if necessary. I'm going to take a look at something. I'm going to show you something on the screen here. It's a very basic example of a business, a hypothetical business, and their balance sheet. And what I've done here is I've just laid out some simple assets, bank loan, and capital. So in simple balance sheet terms, your assets equal your liabilities, which is your bank loan, plus your capital. And this would be the business's assets, liabilities, and capital at cost, which is how things are recorded on the financial statements. So you just took these figures, for example, straight from the business's balance sheet, and you elected, or someone elected, to adjust these to the fair market value on each of these assets to value the company. That's the assumption we're operating under here. That this is what was done. We're going to take the assets less the liabilities. We're going to adjust them to the fair market value that they could be sold at. And that's going to be the new value of the business. Okay? So let's say, for example, the accounts receivable had some things that weren't likely to be collected, so adjusted that down by $10,000. The inventory had some obsolete items, adjusted that down by $5,000. Some equipment and vehicles were actually worth more than they were reported on the balance sheet, so we bumped those up $5,000. The net of all those is a $10,000 negative adjustment on the assets. The bank loan we didn't touch, and that netted out to an adjustment from $430 of net of this business, what it would be worth, to $420 when that all netted out. So just to recap, the assumption here is this is how the person is going to value the business. All right? So they came up with an estimated value under the asset approach, which is one of the three approaches available, one of three. They decided to go with $420 and call it a day. All right? Now, why might this be a problem? This gets directly into the goodwill discussion on the bucket video. So this will make a lot more sense when I blow this up. So take a look at this. Now let's say after significant analysis was done by the business valuation analyst, two other approaches were done, the income approach and the market approach for the same business, and it was determined that the ongoing cash flows of the business would be $100,000 forward-looking. The forward-looking risk rate was 18%. So when 100,000 is divided by the 0.18, it results in an estimated value of $555,000 of the business. And under the market approach, again, after significant work was done to look at comparable companies, forward-looking estimated revenues for the same company were estimated to be $1.85 million. Multiples of comparable companies were judged to be 0.3, so it was multiplied by the 1850, resulting in an estimated value under the market approach of $555,000. Very similar to the income approach. Now, this almost never happens, but we'll say that it did, okay? Oftentimes, there's some disparity between these, hopefully not too much, and it can be explained, hopefully. But let's say that this is what was done. This is how it resulted. Now, what do you notice? How does that compare to the asset approach? Well, they're both higher, and they're both pretty significantly higher. And down here is the difference. Under the income approach, $135,000. Under the market approach, $135,000. Just about the same. Now, what does that represent? That represents the goodwill. Okay? In the bucket video, that was the invisible stuff we poured into the bucket. It's not booked on the balance sheet. However, it is still valuable, and as evidenced by these two approaches. Now, what's happened here is that the business has been undervalued potentially by $135,000 if you just use the asset approach and called it a day. That's the goodwill. All right, so that's also in this case, that's the estimated error that was done with this approach up here. Hopefully that makes some sense. I'm going to give you this to take a look at, play with if you want. And of course, give me a call or send me an email if it doesn't make sense. All right. Now, just to kind of drive this home a little bit further, the second tab would not be a balance sheet that the company would have, but it would be somewhat of a hypothetical balance sheet that you could adjust to given what was just shown. So in essence, what this company has is invisible, so to speak, unbooked goodwill. However, there's nothing the company has done wrong. The goodwill is in the business in terms of the abilities of the employee, expertise, maybe some trade secrets, all the things that make a business valuable that don't necessarily go into the cost-based balance sheet. All right? Very important to understand. So adjusting the balance sheet for this invisible, so to speak, goodwill, we come up with a plug number here of $135,000, which is the same number we had over here, which was the error after using just this approach to value the business. All right? Hopefully this all makes sense. I kept this relatively simple to hit the major issues that are important in understanding goodwill, what it is, and how it comes about. And it often is present in a business valuation of many companies that produce positive cash flow and are profitable. So keep this in mind, particularly if you are in a litigation and divorce setting and goodwill has case law and written law associated with it. This could be extremely critical to your case. And it could be critical in tax court. It could be critical to doing tax planning, estate planning, all kinds of areas. So goodwill spreads out into multiple areas. So you have to understand this concept if you're going to be doing any kind of valuing of a business. All right? Josh Horn, CPA. I've had a lot of fun with this. Let me know if you need anything. Take care. Bye-bye.